Well, in the year since Lehman's bankruptcy, Citigroup has doubled its cash holdings to almost $250 billion. That's the biggest stockpile of any U.S. bank. Well, Brad Keoun is the Bloomberg reporter who sifted through the numbers and wrote the story. He joins us now. Brad, in terms of what kind of an effect does this have on the markets?
Well, really, it's an effect on the bank's earnings. You have banks that are being essentially forced by regulators to keep much more cash and other liquid assets on their balance sheets, and that means that they're not putting it into loans, which earn them much higher rates of interest, and it also does mean that they're probably putting fewer loans out, lending less to bank customers.
Brad, it's so great that you guys did this story after we got that Fed data showing that bank cash holdings were up more than $160 billion as of the latest data, more than $1.3 trillion out there, and it certainly creates a challenge for the Fed in a week when we're going to hear from them as well.
Yeah, I mean, clearly the Fed is one of the regulators of the banks that is pushing for the banks to hold more liquidity. The Treasury Department put out a statement in September saying that this was the direction that they were going to go in coordination with international banking supervisors over the next year or so. And you know, the focus of banking stability has historically been looking at their capital, and now it's clear that liquidity will come alongside that as something that is specifically monitored.
Hey, Brad, it's Adam. You know, the Tier 1 capital ratio now jumps up to about 12.7, which is great. And obviously, they're trying to show they've got a great balance sheet, and that's up from, 10% a year ago. It's better than Bank of America, better than JP Morgan. But, it sort of cuts both ways, doesn't it? Because they're not loaning. So, yeah, they've got the capital, and that makes the balance sheet look good, but they're just not loaning.
That's true. Essentially, having so much cash on the balance sheet artificially inflates those ratios, because the ratios are really a function of a numerator, which is the capital, and a denominator, which is their risk-weighted assets. And so what you do is you take the total assets on their balance sheet and you weight that according to how risky it is. So cash actually gets a 0% risk weighting, and loans would get a much higher risk weighting. So if you have a lot of cash, it actually artificially shrinks that risk-weighted asset denominator and makes your ratios look healthier. But yes, that's the point,
Brad,
that they're not lending as much.
I was just wondering, I mean, do they do this because they think Armageddon is on the way, or is it just because they want to comply?
Well, it's a combination of complying and also wanting to make sure that they don't get caught short of cash if there is another Armageddon. We talked to a couple people. In fact, Jamie Dimon, in an appearance last week at a securities industry conference, said he doesn't think that Armageddon is on the way, but these banks really just want to be prepared for whatever happens.